Let's bring in Ryan Lamond, CEO and co-founder at Neovision Wealth Management. Ryan, thank you so much for joining us. I want to start with the Fed because we've seen traders gradually pairing their bets around what to expect at the December meeting. It's now pretty much a coin toss whether it comes down to we get a 25 basis point cut or not. What's your view on this?
Well, Chair Powell has made a statement, and that statement is quite clear. He said, well, we're unsure yet. This is what we understand from his statement. Another thing we pull from his statement is the 50 basis point cut that happened in September. Let's remind viewers that this happened only twice in history, and what followed were massive crises. So was the 50 basis point cut justified? Was it too big? I'm not sure. So even the Fed is unsure about December. Markets are divided between stock markets and fixed income, and both are telling completely different stories. Retail sales are very strong. So I don't see a 25 basis point cut in December, given the current situation that we're in at the moment.
What does that mean then, Ryan, just moving forward? If you don't see a cut in December, do you continue to see a pause throughout at least the first few months of the Trump administration?
Well, Jennifer, what we see today is a 10-year at 4.5% and the stock markets at 23 times earnings. These two are not compatible together. Something has to give. So if there is no cut in December, we see 10-year rates at 5% and equity risk premium going below zero, which is obviously not a good thing. So we see stock markets in the U.S. probably going more towards the 5-year average of 18 times earnings. So this means that the S&P will have to go back below 5,000 points. So positioning here is very hard because there are so many elements that are in place at the moment. We don't know yet what President Trump will do. Will he pressure again the Fed, even though the Fed is independent, we know that? Will he pressure the Fed as he has done in his first presidency to cut rates? There are many, many unknowns today. So from a tactical perspective, positioning is quite complicated, and we do expect some volatility on the U.S. stock markets. And that is why we're advising our clients to go towards countries where we see tariffs being imposed on, because this is where governments will have to move, will have to support their markets, economy, and stock markets.
Can you tell us about some of those countries, and do they include China? Do you have a suspicion the policymakers in China might be keeping a fair bit of dry powder in reserve for 2025 when the realities of the Trump administration really begin to dawn?
Well, Paul, I'm smiling because we've done very well on China. We started getting in early summer a few months ago. We've had a very nice run on the back of the announcements or positioning that was done by the Chinese government. We see $240 billion bazooka, what's called bazooka, support that is coming, in our opinion. So this will support Chinese stocks. The only unknown and uncertainty there remains the Chinese consumer, where it remains relatively weak. But from a stock market perspective, we do see some strength there. Another one would be India, where we've done very well as well. And finally, Europe. Europe, it's all pending on what the settlement will be with Ukraine. But we do see some opportunities in Europe from a tactical perspective, very short-term perspective.
Talk to us about what sectors in particular, Ryan, because Europe isn't always something that we hear from asset managers about moving into. I mean, where are you looking?
Well, again, we're bargain hunting. There's no specific sector. Rather than doing a top-down, we're doing a bottom-up, total stock picking, undervalued, dividend-paying, stability, non-cyclical. And this is where we're finding some value. These would anchor our portfolio. This is not really a performance kicker, but more of a stability, low volatility type of stocks. We still need developed markets in our portfolios. We cannot only go to emerging markets, China, India, Brazil, etc. So that is why Europe is very important. It's sort of an anchor, if you will. But I cannot give you a specific sector because it's purely stock picking driven. Dividend, stability, and non-cyclical.
If we're talking about anchors, I know you've got quite a large gold allocation, 25%, correct me if I'm wrong. You're not alone here. Goldman Sachs sees gold at 3,000 by the end of 2025. But are you worried about something?
Regarding gold, we see it as a very important asset on the back of the geopolitics, on the back of the dollar being less of a dictator, and we're seeing more of a democratic diversification of reserve currencies. We see gold rising in price, not because there's a shortage of gold or fundamental related to gold. It's more the US dollar weakening against the gold. This is our play. So we see the dollar, there's the price of the dollar, there's the value of the dollar, and then there's the purchasing power of the dollar. The price of the dollar is quite high. However, its value is dropping against gold. And this is why the gold trade is very important for us. And finally, purchasing power of the dollar is dropping over time. Hence gold. There will be volatility. We've seen it. It went above to 2,700, close to 2,800, went back down, and this is when we started purchasing again. Yes, we see the target of 3,000 within reach, but again, there will be some wobble. There will be some opportunities to buy the dip, and we are advising clients to use these dips to buy more.
What would be the catalyst then, Ryan, for the dip in your perspective?
Well, the dip, we've seen it basically on what happened last week in the US. The strengthening of the dollar on the back of Jerome Powell's announcements has triggered that profit taking. So I don't see it as a weakness. It's more of a profit taking. And we did book some profits as well. So all of these contribute into these dips. We see more of these coming up every time there's a catalyst, every time there's a steepening in the yield curve, every time there's an announcement by the Fed about a pause, a strength in the US economy, we might see dips. And again, we see these as opportunities. Against 23 times earnings on the stock markets, we prefer gold in this case.
Ryan, still bullish. Good to get you on and get your insights. Ryan Lamond, CEO and co-founder at NeoVision Wealth Management, joining us there this morning. All right, coming up, Senegal's ruling party claims